Ladies and gentlemen, welcome to Entrepreneurial Finance Buyouts. What is buyouts? Let's look at an example. Rwth was a big transaction, was considered a buyout, actually a leverage buyout, which happened a couple of years ago. And there was more than one buyout associated to that example. So how this started was basically when BC partners bought all available Rwth shares. Family wanted to sell, so they bought the family shares plus the free float, which was because Rwth was listed on the stock exchange, and the company in the very end was delisted from the stock exchange. So it became a privately held company, and this is also why this is still a private equity transaction. That was the first transaction which happened with Rwth, that BC partners basically bought out old investors, which in that case was family and the free float, with the help of their own capital, which is the equity capital, plus some leverage, some debt capital. And later on, after holding that company for some time, a second investor came in. After restructuring, BC partners sold the whole company to a consortium of investors, which is a bank on the one hand, Credit Suisse First Boston at that time, so CSFB, plus the Texas Pacific Group as new investors. And this is very typical for leverage buyout transactions, that they look a little more complicated, and we should look into what that means at the very end. So what is a leverage buyout? What is a buyout in general? Well, buyout, first of all, is that an investor is bought out, or a family or an old shareholder in general is bought out by someone new coming into this company. And this could be buying all part or a part of a company from previous shareholders. After the transaction, the previous shareholders might still be part of the company. That might happen. That was not in the Rwth case. And after a transaction, also, the new investor has to restructure in order to create some value. Let's look at that later on. In most cases, those buyout transactions are being done with a lot of debt capital, 60, 70, 80%. It used to be more in recent years. Nowadays, it's a little less. In order to use that kind of leverage effect. So if the total return is higher than the interest rate, you can always try to use borrowed capital to leverage your equity capital. However, if the proportion of borrowed capital is going to be too big, the interest rate is going to be too high. So then there's an end of leverage, basically, to those transactions. And this is what a leverage buyout or buyout transaction is about in general. What is the process of that transaction? Actually, first of all, if you want to do that as a target company, so Rwth wants to sell the shares, the family wants to sell the shares, they have to prepare the transaction. Or on the other hand, BC partners, for example, they have to look for potential target companies. Then they have to structure the deal. Structure a deal means financial structuring on the one hand. So what's the equity, what's the debt capital, and there are tranches of debt capital associated in between. Then they have to implement the whole deal, which basically means create value. And afterwards, they have to exit again, because it's in most cases, it's investors. And if you look at investors, the main business model is buy low, sell high. So BC partners wanted to buy Rwth cheap and sell it more expensive to someone else. In order to realize that, they have to realize value creation, and they have to exit again. So a buyout transaction in general is an exit transaction for a company. Might not ideally be for entrepreneurial companies or very young companies, far more mature, which is Rwth in that example, but you always need like a secondary exit mechanism, which gives your new investors the chance to exit that company again. If you look further into what happens in this transaction, you can first of all look at the preparation phase, and if you can look at that from perspective of the investor. So then you have to try to find out potential target companies, or you can also look at that from the perspective of someone who wants to sell. Then you have to look for an investor. In both cases, you have to try to understand the investor, you have to try to understand the management and the owners, and then you can identify the whole investment. Then you analyze the whole thing. Is there some potential for value creation? So this is a very typical financial buyer. So he needs to find a value gap which he can realize in order to realize a higher value of the company. You have to look at that. In most cases also those companies need good cash flows in order to realize or in order to carry those significant amounts of debt. And you have to do a business plan, at least to some extent, evaluation, in order to understand whether the business can be potentially sound in the future, whether you can realize that value creation. This is the preparation phase, so this is the very start, and then if you go into the structuring, you basically do, that's the main thing, that financial structure, which is the question between equity and debt. And as I said, debt is divided into more tranches, so there's junior, senior, and in between. And it is all also about a legal structure and contract negotiations and closing. There's a lot more complicated, and you can see that on the slide. However, that's the main mechanism. Whenever the investor BC Partners has bought Rwth, then they try to realize value. And this is when basically program offices come into place, consultants, people who can do some kind of turnaround with these companies. And there's basic measures you can go and you can do to realize value. The first one is you change the strategy, you change the portfolio, so all sorts of strategic measures. The second thing is operational improvements. So you restructure the company operationally. And the last one, you can also change something in the organization. All of these measures, the three measures, are basically being done in order to realize higher earnings. So if you do evaluation of the whole company on an EBITDA level, for example, you multiply EBITDA by 5 or 10. If you have a higher EBITDA with the same multiple, you realize 5 times, 10 times that difference as in excess value. And this is why you do the whole thing, why you do the implementation of value creation. Whenever you've done this, then you can try to sell again. Besides that, you can also do some financial structuring. You can try to get a higher multiple when you sell the company, but this is also measures to basically create value for the equity investor. So this is the third exit mechanism which I wanted to describe. You see, it's the most complicated one, and it's basically the one which is more important for more established firms who can have cash flows in order to realize the debt structure and so on. But it is an exit mechanism in general, and so it is part of exiting the firm.